Welcome to XYPN Radio, where your host Alan Moore brings you into a community of fee-only financial planners who want to profitably and successfully serve Gen X and Gen Y clients. If you're ready to get the knowledge you need from leaders in your field, learn from forward-thinking advisors, and take action on your own goals, XYPN Radio is the show for you. Here's your host.
Hello and welcome to this episode of XYPN Radio. I am your host, Alan Moore, and today I'm excited to bring you another mailbag episode where Michael Kitces and myself get really drunk and answer your most pressing questions. And of course, I am kidding about us being drunk because honestly, that episode would go on for like 4 hours and no one wants to hear that. So today we tackled a few listener questions, starting with a conversation about using mass emails, aka spam, to solicit for new business, and if it's a good idea to tout lower expenses or lower fees as the main reason clients should hire you. Next was a question regarding whether or not we think advisors should drop their insurance licenses to go fee only. And we wrapped up with a discussion on if it's appropriate to ask for time off to study for the CFP, or if that studying should be done on your own time. As always, you can find any of the resources that we mentioned during the episode at xyplanningnetwork.com/63. Also, be sure to go to xyplanningnetwork.com/VIP to join our private group just for XYPN Radio listeners. You can interact with other listeners, ask guest questions, and more. Without further ado, here is Michael and myself. Good evening, Michael Kitces. How you doing tonight, man?
I'm doing well. How are you, Alan?
I'm good. This is my new intro. As listeners know, I have no idea how to ever bring Michael into these mailbag unhinged episodes, so we'll just keep mixing it up until something doesn't feel goofy, which was an epic failure this time. We'll try again next time. So today we have a unhinged episode where you get to hear Michael and I reach into our virtual bag of mail and answer questions from our listeners. So, for listeners out there, if you have any questions that you'd like for us to answer, just go to our VIP community at xyplanningnetwork.com/VIP and you can post your question there. Or if it is super, super private, you're always welcome to send it to us directly and we'll see if we can work it into the show. So without further ado, and no, I guess we normally end up kind of like riffing for 15 minutes about nothing. So we're just going to jump right in to questions. Does that sound good?
That works for me. Let's try just actually getting to the questions in the show. Sure. That's a neat way to mix it up.
Start with questions. We can tangent later. I'm starting to use tangent as a verb. I'm not sure that that's allowed. So for all the grammar folks out there, I'm sorry. Tangenting.
I'm going to call it permissible.
Tangenting is my other good ones.
I will allow it.
All right, here we go. So question number 1. I'm going to be launching my own firm and looking at some various marketing strategies. Are you legally able, I guess this is from a compliance as well as I guess just overall legal standpoint, allowed to basically email spam folks and just kind of use spam as a marketing technique, saying you're paying too much, come use our services? I think this is a really interesting question because, we are starting to see financial advisors, trying new marketing techniques, and they're looking at other industries and they're seeing what's working, what's not working. Obviously, financial planning firms generally have been built on the back of, referrals from existing clients. But if you don't have any clients, you're just starting a firm, where are you going to get your clients from? And so, email marketing and what starts to look like spamming, in my opinion, has been effective, maybe in some industries, or at least they make it look effective. So are you aware of any planning firms that successfully, maybe spam is too aggressive, but basically are mass emailing people that didn't opt into their list, which I am calling spam, for one? And then 2, what do you think about the kind of the marketing tagline of you're paying too much and come look at us, and really focusing on price?
So a couple of different things come to mind. Offhand, I really don't know of any advisors that are just, sort of mass email spam sending out, or shall we say are doing mass unsolicited emails to try to generate interest in clients. Now, that's not to say there aren't people who haven't done mass spam mailings for getting business. They do it in direct mail. They've done it for a long time. Ken Fisher's firm is legendary for the fact that they have $60 billion under management. I believe they're technically the largest independent RIA out there. And the bulk of the business was built by doing unsolicited direct mail to basically high value zip codes. And they built most of the business in that context with, Ken Fisher's infamous I hate annuities marketing line is a big focus of his. So it's at least been done in the direct mail context. Now, I have to admit, I'm a little more skeptical about the email context for a couple of reasons. The first is there is a law out there. It's called CAN spam. It says how you're allowed to do basically spam solicitations or not. And abusing those rules has $10,000 fines, I believe, per email. So, and I'm not quite certain how you're going to get a mass of email addresses and spam out to them without running afoul of that. There's a list of requirements you have to do. You have to give them an opt-out. Part of the CAN spam rules is that people are not supposed to sell you email addresses in the first place. So the biggest challenge actually when you get into this is where on earth are you going to get a critical mass volume of email addresses to initiate your spamming strategy? Like there's a reason why people pay huge amounts of money to advertise on places like Facebook, because Facebook has your information and email address and can sell third-party advertisers the right to advertise to you, but they can't sell your email address because that's illegal. And so if you're on the other end, I want to do mass email spam solicitations, and I want to find email addresses, that gets problematic. When you look at where a lot of them come these days, a lot of the email, spam email that you get, it's actually off of things like malware and illegally obtained email addresses in the first place. So, the idea of doing this, I think, is not unheard of, but how you're actually going to get email addresses and not violate CAN spam, I think, is a really serious challenge. At best, it will be costly even to get legitimate email addresses. And if you're sending spam to them, they're going to unsubscribe, or there are all of our email filters, Gmail, Outlook's Clutter, all the rest are going to pull it all out anyways. And so I'm not sure who you're going to reach or whether the people you reach are even the ones you're going to want to reach, and just how realistically effective that is, both because of the medium and the laws around spam.
Yeah, it's interesting. You got a really good metaphor there with, direct mailing, which I guess was the original
spam.
And I saw a statistic on it the other day, and it was just ridiculously low, the number of people that ever actually read direct mail. So I don't think Fisher could have done that in 2016. He might want to come on the show and argue with me, and I would welcome that because it'd be interesting to hear. But that's probably a time before today. And email spamming, I would just say that was probably 10 years ago too, before Gmail had, unbelievable filters that could identify spam mail and that spam email and that sort of thing.
And frankly, part of the dynamics of spam email in today's environment is the email filters are getting better at screening out mailing lists, servers, sources that are questionable in the first place. Obviously, they don't filter it perfectly because we all still get the spam email, but the amount of stuff that's actually getting filtered, you would be shocked at if you ever looked at the raw inbound mail and how much is coming through. I can actually see it because I run my own email server for Kitces.com, and the amount of stuff that's bouncing around out there that these things are screening out is mind-numbingly large. And the point just being, I don't think you're realistically going to get much through. And the more you're not doing it with a permission-based build an email list because people said they want you to send them stuff kind of thing, the harder it's going to be.
And I will say that emailing a list of folks that have opted into your email address and trying to get them to do something. So, we have 5,000 something newsletter subscribers, all people that have opted into the XY Planning Network email list and have said, please email me. We want you to do that. When we send out stuff about, hey, we have conference passes available, I promise 5,000 people do not buy tickets. We may wish they did, but that it's hard enough to market to your own list that was generated naturally, organically. I cannot imagine the ridiculously low conversion rates, again, of people that it actually makes it to their inbox and not get caught in a spam filter, that they actually open it, they actually click it, and above all else, they're actually the type of client that you want to work with.
And I think that's kind of the end point is are they actually going to be the client that you want to work with in the first place? That's actually the ultimate irony for all of those infamous, I'm a Nigerian prince and I need to send $7 million. Will you help me wire this? Those kind of like obviously fake, fraudulent kinds of emails. There's actually a reason why the scammers that do that still use those emails. And the reason is they know it's going to have like a 99.99% failure rate because either the email isn't through or it gets through and it's obviously false. It works because if they write the email that obviously fake and someone actually still responds, you've got a sucker. And so just when you kind of think of environment, I mean, who do you want to work with? Do you want to work with reasonably affluent, sophisticated people who are, good clients and value third-party advice and all the kinds of things that hopefully would be people you would enjoy working with? I have trouble believing those are the kinds of people who are going to hire you based on unsolicited email or even going to believe promises and headlines like, just open this email and I'll show you how to save lots of money on your investments. Like that kind of pitch. I question whether the medium is going to get you to the clients you want.
Yeah, I totally agree. And I just think that ultimately the types of folks that are going to open that email are just they're just not the ones you want to work with. So, okay. So we're saying only email people that give you permission to email them. Because I will say, as someone who now, has the ability to direct folks to our 300 XYPN members, nothing drives me more mad than when a marketing person will email me and say, hey, I have this awesome offer for you. And they don't have an unsubscribe link at the bottom. And I have never heard of them. So I never opt to their list. So they went and skimmed it off of some website, emailed me without permission, then didn't give me an unsubscribe link. And I am not very nice to them whenever I email them back, usually saying the same thing about like, look, what you're doing is illegal. Get me off your list. Don't email me again.
I actually have a template that gives them references to the canned spam law they're violating and explains to them the Federal Trade Commission email address I'll be forwarding their next correspondence to if they don't stop unsolicited spam.
Of course you would. Well, Michael will make that templated email available in the show notes.
Sure. It's relatively simple. It gets the job done quite well, quite effectively.
Michael, don't you love it when I volunteer you for things?
Yes, I love being voluntold. The other piece of this, I think that is, well, all right, so one other quick thing on this. The other actually issue worth noting when it's worth recognizing. I realize most people listening probably weren't actually imagining doing mass unsolicited spam in the first place, but this is a good note. So one of the big things, when you get into the world of email marketing, one of the big issues is email deliverability. So it's like from the sender side, are the things I'm sending out actually getting to the people that I'm sending them to? Because as I mentioned earlier, the reality is email servers actually skim out huge amounts of stuff now, as does, Gmail and Outlook and other programs. They dump it to side folders, or they auto-filter them, or, anti-spam software grabs them and pulls them aside. Now, what that means from the perspective of the companies that send emails, so services like MailChimp, Constant Contact, Aweber, ConvertKit, those kinds of groups. One of the reasons why their email deliverability is pretty good is they are very rigorous about making sure that people who use their software use it properly, which means you're complying with the canned spam rules yourself. You are not buying illegal email addresses. You're not just manually adding in email addresses that you didn't have permission to market to. And for most of those services, many of them, you cannot add an email address unless they actually double opted in through their service. Like if you come and say, I've got an existing list of 50,000 people, they'll say, great. All you have to do is send them another email that asks them to re-opt in, and we'll add them into our system. So that you couldn't even manually add them if you wanted to. For the few systems that do, if you manually add them, they are going to send the email out on their stuff with their unsubscribe links and also their complaint links that are built in. And if you send your first email out and it's a bunch of addresses that were unsolicited and inappropriate, and they get a whole bunch of complaints, they will unequivocally bar you. They'll ban you as a customer and say you're not welcome here anymore. So the other dynamic of why it's important to play right under the email marketing rules and kind of the challenge for this person is the biggest problem you're actually going to have is no reputable email provider is going to cooperate with you because they don't want to get their servers stuck on blacklists. So they're going to make you do it on your own. And your server is not going to have the credibility of theirs, which means most receiving servers will reject the messages. And if you're not already a banned email server, you will make yourself a banned email server with the amount of complaints that are going to come back at you.
Yeah. So, and when Michael says complaints, it's actually not all that hard. So to complain about emails, you just click unsubscribe because MailChimp, Constant Contact, they're all monitoring whenever someone clicks unsubscribe. So when I first started my practice, I was setting up my MailChimp and I accidentally clicked I was integrating Gmail and MailChimp and it asked, do you want to import your contacts or sync your contacts from Google or something like that? And I clicked yes. And it literally pulled in like all 4,000 people I have ever emailed in my entire life from my personal email address into the system. And I just didn't catch what was going on. It was the first time I had ever done email marketing. And so when I sent out an email at some point, a ton of people unsubscribed and MailChimp deactivated my account immediately. And so I obviously sent an email and I was like, I have no idea what happened. I am so sorry. Do you just want to delete all of my lists? I promise I was not trying to spam. And they were kind enough to go through, clean my list out for me for that. They basically just deleted that import and let me back on their system. And it was just because something like 300 people unsubscribed to one email. So it was pretty freaking obvious that they didn't want my email coming to them. So it's very easy to do to mess some of this stuff up. So yeah, you do have to be careful. And again, you do not want to get tagged as a spammer because you start not being able to ever do any email marketing. But I do want to push into the second portion of this question, which is, so aside from spam, what are your opinions and thoughts on the marketing technique of basically pushing out, hey, you're paying too much, come use our service. So the marketing is all around kind of the fees. And we know historically clients are probably overpaying their investment advisor by the time you add up all the various fees of mutual fund expenses and brokerage fees and custodial fees and 12B1s. And then the advisor, you may legitimately be half, if not, a third of the cost of other investment advisors. Is that a marketing technique that you recommend?
It's generally not. A little bit of this depends on what exactly it is you're marketing, as well as, which part of cost you're trying to differentiate on. So I do know a couple of advisors that certainly have had success specifically marketing around investment costs of funds. You're paying too much for your high-priced mutual funds. I can, craft for you low-cost ETF portfolio at a fraction of the price. And, the reality is much of that investment service, particularly if you're going to do passive strategic portfolios with index funds, is largely commoditized anyway. So there's at least some room to undercut and then still scale up what you're doing. The challenge to this, though, is I'd be really careful about marketing things like you're paying too much for financial planning, come to us. It's one thing to try to market, hey, I can connect you to some products that are cheaper. It's another thing to literally make your services the low-cost alternative. And the reason, actually, kind of getting back to the earlier discussion that we were just touching on, it becomes a question of who you're trying to reach and who you want to work with. When you lead with a message of, I'm the lowest cost provider, you're not just saying, I'll save you some money relative to the next person or the person you're already working with. What you're saying is, I work with people who respond to cost-conscious messaging. And the problem with working with hyper-vigilant, cost-conscious people is the marketing pitch that gets them to come to you is the same marketing pitch that the next person's going to use in 6 or 12 or 18 months to peel them away from you. One of the challenges of working with hyper cost-conscious customers and clients across a lot of industries is when you really get people whose first buying decision is driven by cost, they are not loyal to brands. They are not loyal to service providers. They're not loyal to the people they work with. They shop on price. That's what they do. And I'm not trying to judge them or say that's a good or bad thing. We all have our own decision frameworks around how we shop for products and services, but recognize the position you're putting yourself in. If you try to appeal to cost-conscious people being cost-conscious, you're inviting the next person to take them away from you by using the exact same messaging and just figuring out how to be slightly cheaper, slightly better, slightly more cost effective, have a slightly less expensive thing. So it becomes a very difficult business to sustain. You may get people in a little quickly if you hit the right audience, but you may find they leave you in a year or two as quickly as they came in, and it becomes a very ephemeral business.
Yeah, I totally agree. You cannot always be the cheapest provider. You may be able to come in and undercut the competition today, but not too long from now, someone will come in and undercut you. There will always be someone who will do it cheaper because eventually it will be, end up in cheaper labor markets with folks that are happy to work for $2 or $3 an hour that are doing your job, right? Like ultimately, we see this in every single field out there, whether you agree with it or not. Politics aside, ultimately there is always cheaper labor. And so there will always be someone that can either build a more efficient technology system or find folks that will do it for cheaper than you. I am so not a fan of marketing based on price because that is a never ending pit that ultimately you just can't dig out of. And like you said, anyone can come along and undercut the folks that you're trying, that you brought in with that messaging. They're just going to take them from you. So,
well, and again, I think it's important to recognize this dynamic of who you attract. Because I know people have said like, well, I'm just doing it to kind of get them in the door, but then I'm gonna do more services for them, and I'm gonna do more stuff for them, and I'll expand what I deliver to them, and we'll deepen the relationship over time. And the problem is when you really lead with a cost-conscious message, it's really difficult to do that because the people you've brought in are not the kind of people who like to expand their loyalty to multiple services and value you. You've brought in people who like to shop based on price. So, there's even a difference between saying like, hey, here's my niche and what I specialize in. And we're so good at doing this that not only are we better than everybody else, we do it a little less expensive too. Working the cost in is not necessarily a bad thing if you really are legitimately cheaper and better than your competition. But leading with it, making that the central marketing message really starts to attract a different type of clientele. And while I know some firms that have succeeded around things like focusing on low cost investing, it also means they run usually a fairly lean business that just ends up focusing heavily on that. I don't know very many who have done that and successfully expanded into doing other services and making higher margin and making better profits as business owners because you get stuck with clients who are shopping on price. And, the minute you try to say, hey, well, we got another service we're rolling out as well, they're like, well, I don't want that. I'm not going to pay for that. I'm just paying for the low cost thing I came and bought. And it gets hard to grow the business.
So I think we are both saying no and no. Moving on, 20 minutes to get to the central answer. Obviously, our opinions here, but yeah, I just don't see the need to do either of these.
Yeah, just recognize the different. Last note I want to give on that, just recognize that there's a difference between trying to differentiate on cost and trying to differentiate on value. Value is what you give relative to your cost. Cost is just kind of an absolute differentiator. We all want to have good value. We all want to be able to convey that we give good value for our price, right? Whether you're Walmart or Tiffany's, they all try to convey that they've got good value at their price point. But there's a difference between trying to convey good value at your price point and just being the lowest price point. Just trying to be the lowest price point is a brutally difficult business because someone's always coming along next to try to do the same thing to you. And they know to go after your clients because you have the cost conscious clients.
Absolutely. All right. So moving on to question number 2. So this is a really interesting one that we're actually getting more and more often lately around insurance. So I know XYPN requires members to be fee only, but I occasionally sell life insurance to my clients. I feel to be a true fiduciary, we need to be able to help in all areas of their personal financial lives, which includes insurance. Why should I have to give up my insurance licenses to be fee only? Any opinions?
Yes, I have opinions.
Shocking. We have opinions on this. Yeah, so obviously this is a huge issue that we're seeing out there because the CFP board has defined fee only as no commissions. And not only that you don't receive commissions, but that you cannot receive commissions, which basically means if you're insurance licensed, you can't call yourself fee only.
Just for the record, you can technically maintain an insurance license as long as you're not appointed with any companies. That was kind of
That's a fair delineation.
CFP board modified that about a year and a half ago because there are actually a few states that to give advice on insurance, you are supposed to be insurance licensed, and some states don't have a separate insurance advisor's license versus an insurance producer's license. So you would have to drop your license to your fee only, you would have to be giving illegal insurance advice. So see if people are actually compromised on that you can have an insurance license, but you need to not be appointed with any insurance companies to actually do business.
Thank you for that delineation. I think that's very important because, like you said, I remember when I was in Wisconsin, we were all supposed to be insurance licensed in order to basically talk about insurance at all. And those are probably some archaic rules that were forced in by the insurance lobbies, but that's a rant for another day. But, should you want to be fee only, it's going to require you to drop doing insurance. But this question becomes like, well, aren't I, a better advisor if I'm able to sell insurance? Shouldn't I, why can't I offer a one-stop shop for all of my clients? We get a lot of questions around these various pieces with insurance.
So I have to admit, and I don't try to caveat this. I don't want this to sound as maybe harsh or antagonistic as it will sound to some people who are probably in this exact position as the person who submitted this. But this is the quintessential example of why fiduciary rules and fee only matters. The kinds of conflicts of interest that products produce and the ways that we rationalize why it should still be a good thing to sell the product that we sell. And so here's where I'm going with this. So, the person who wrote this made the case, well, shouldn't my clients need insurance. So to be a good fiduciary, shouldn't I follow through with them and help them implement the insurance? And so the question I have for you is if that's your worldview, well, it's also crucial that clients comply with the tax code and file their tax returns every year. So are you also going to be a CPA and do their tax returns? And it's crucial that our clients get a will. So are you going to actually become a lawyer or hire a lawyer to work for your firm to to draft all their wills and trusts and their business entities and any other legal services that they have? And, we can go further down the road with this. The reality is a person's finances span lots of different realms. And we don't do all of them as financial advisors, right? I'm not my client's banker. I don't do mortgage loans for my clients. There are actually a whole bunch of things. I mean, if we're going to go down this road that we don't do as financial advisors, the one we happen to do is insurance, because historically that's where the industry was and that's what we happen to do. And we've got some convenient, easy licenses that happen to fit well with how most of us were trained. And so suddenly we slip into this trap that it's totally okay. I don't do my clients' banking, credit cards, mortgage loans, wills, trusts, business entities, or tax returns. But insurance is suddenly the one thing that I should clearly have to do in order to be a fiduciary. And I think it's the thing we tell ourselves, and I'm going to say the collective we. I started in the industry as a life insurance agent. So I have lived this transition of going from insurance agent and being broker-dealer licensed to dropping those licenses. And I remember when I did the transition, I was literally counting down the days until my licenses expired so that I was trying to decide what was my bailout period where I could go back if I changed my mind or freaked out. But the reality at the end of the day, frankly, to be a good fiduciary, you need to be advising on all of these things, and you can deliver great value to your clients by advising on all of these things and helping to hold their hand and make sure they follow through. But it does not mean you actually have to be the dude or dudette that sells the life insurance any more than you need to be the one that sells them the mortgage, brokers their real estate transaction, drafts their will, or prepares their tax return.
I think that's an excellent angle to be looking at this. The other angle I take is, according to the CFP board, kind of their code of conduct, my personal feeling with the definition of fiduciary is the only way you can truly be a fiduciary and stay within the CFP's code of conduct is to truly be an expert in the area in which you're advising on. So this is another piece too, that if you're writing, one insurance policy a quarter, you are not up to date on the insurance industry. I'm sorry, you cannot be an expert. Just imagine, a attorney that writes 2 or 3 wills a year, right? We would not trust them to work with our clients. And yet we think that because we write a couple of insurance policies a year, that we're kind of up to speed on it. And the insurance world is changing so fast with new types of products, new companies coming on the market, mergers, just all these, just a plethora of things out there. I know when I was talking to Mark Maurer with Low Load Insurance Services, he told me they've got 16 dedicated agents, all insurance agents, all dedicated to this area. And they're struggling to keep up with everything that's happening. So to think that one advisor that is occasionally doing insurance, probably what you're doing is you're licensed with a single company, because that's just the company that and you're writing the same type of policy because it's the policy that and to say that that is in your client's best interest instead of relying on an expert, to me is absurd. So I would also take the argument of, one, I think this whole had to be a fiduciary because I have to do it all. I think that's absolutely true. 2, you cannot be an expert in all things. And if you're going to be a financial planner, you just have to take financial planning, which, to be fair, is kind of a master generalist position. It's the position that we've taken that we know enough about estate planning to know when to bring in the attorney. We know enough about taxes to know when to bring in the CPA. We know enough about insurance to know when to bring in the insurance broker. I always joke to my clients, my goal is to answer 90% of your questions and to know the 10% I shouldn't answer. And that's just the position that we're taking. So don't try to be this expert in one kind of random area, even though I know the commissions are great. You can charge them for insurance advice. You can charge them for the integration of the policy into their financial plan to say, hey, I really think you need these, laddered term life policies in this amount and all of that. But to be the one that goes out and actually shops all of those policies to find the best one with all the riders and all the exclusions and such that are ideal for your client, it just can't happen. You cannot be that knowledgeable about it.
And, I get the challenge of making the transition. We could probably do a whole other show discussion at some point about what that transition looks like. You can just sort of walk away from the insurance business, start referring it out, focus your energy elsewhere and getting paid for your advice. If you've got trails business, you can actually sell some of that. There are people who will buy insurance trails and books of business and then service those policies going forward. And you can still be their advisor, but you just won't be the licensed agent or broker on it that's still getting paid the trails to do the company's servicing work. So there are some kind of exit and transition plans of how you actually let go of that insurance business to switch over if you don't just want to go to cold turkey, which frankly, I find anecdotally is still what most advisors end up doing when they make that switch. But if you've got enough, frankly, trails business that you've built up, you've been doing this for a while, you can sell that trails business. And frankly, the check that you get, which roughly speaking, usually comes in somewhere between 1 and 2 times annual revenue. That can actually be some of the money that you use to seed your new advisory practice, to do some initial marketing, to be your working capital, to be your cash reserves. So, there may be a little bit of money actually that you can get there to help do this transition as you let it go and shift to an advice focus and not a blend of advice and product sales.
Yeah, because I think the final piece, and the reason ultimately we want to hang on to the insurance, is the money. When you're starting a firm, it's hard. We know, we've talked about this several times on the show. We have been through this ourselves. It's always attractive to see these easy kind of areas where you can go grab, a few grand at a time to be able to sell a few policies or hold on to the trails and that sort of thing. But it kind of comes back to our now infamous opinions, I think, on niche marketing and having an ideal client profile and really focusing on what you're doing. And that is that this becomes a distraction. It becomes too much of a distraction to try to get in there and dig around to figure out everything you need to know about the insurance policies. Because if you're actually going to do proper due diligence, you are going to spend, probably 100 hours trying to actually find the right policy. And it's just, the money looks nice. I get it. But ultimately, it's probably just a distraction to actually building out your core business.
Yeah, it becomes one of the safety nets that we like to hold on to. I find this for a lot of us when we're starting a business. It's scary to take the leap and start a business. It's a lot easier to hold on to some stuff that's either familiar that we know or that's outright revenue streams. And feels like a safety net to hold on to and that it'll make the transition easier. And, arguably for some people that may be true, but more realistically, what I find is the people that do that never fully commit to making the transition. And often we end up setting ourselves up for failing in a new business or a new venture or something new that we're doing because we never actually fully commit to it because we're holding on to, pieces like this. And, if you keep one foot in your new business and one foot in the old one as like a safety net against failure, most of the time you just end out hastening your failure.
Yeah, it's so true. Ultimately, entrepreneurship is a dive into the deep end. And we do talk a lot about side hustle. You can start a business on the side. There are some things you can do, but there comes a day where you've got to be all in or you've got to be all out. And trying to toe that line for too long, and you'll never get to that decision. So, all right, moving on to question number 3. So this was actually a response to a conversation that I was having with an advisor around getting his firm registered. And so basically he was saying that he didn't realize he needed to register his RIA. And so he said, I thought I could be an IAR while serving up to 5 clients in each state before I have to register an RIA. But basically, why are you telling me that I need to have an RIA in so many words? So this is an area where Michael nor I are compliance people, but we do know the basics. But I know there's a lot of confusion out there around compliance and all of the acronyms and terminology and stuff out there. So let's just kind of walk through. I'll let you take the lead and you kind of walk through the basics, and I'll pitch in on when you have to be registered, why you have to be registered, what can you do while being registered or not, and that sort of thing. Let's just give an outline for folks out there that are trying to figure out, do they need to register their RIA firm?
Well, so actually first, I want to take a small step back on just a little bit of the terminology there that I think was actually maybe confusing the matter further, which is, I think that question was something effective. I thought I could still be an IAR in some of these states as long as I have fewer than 5 clients and I wouldn't have to register as an RIA yet. So just to be clear, difference between IAR and an RIA. So an RIA is a registered investment advisor. Technically and legally, that's the firm, the business entity that is a registered investment advisor. Now, for those of us who are sole proprietors, it kind of becomes us as the person. But technically, the RIA is the business. The advisor who works in the business is an IAR, which is short for investment advisor representative. So technically, any advisor who works for an advisory firm is an IAR of an RIA. Like, they're not mutually exclusive things. You're one or the other, and you decide to be one for a while, and then you switch to the other. By definition, if you have an RIA and you are working in it, you are an IAR of that business. Again, as a sole proprietor, it's kind of a distinction without a difference, but they are separate roles. There's no such thing as being an IAR and not having an RIA, though, which is the point. It's like, if you an IAR, if you are an investment advisor representative, you have to be a representative of something, some firm, some RIA. So just to kind of eliminate that, hopefully, that point of confusion up front, what we're talking about here is being registered, having your business registered as an investment advisor, which as a sole proprietor means you will automatically be the one and only IAR of that RIA. But you're not like being IAR for a while and then going and getting your RIA later. What we're talking about here is what triggers you needing to register as an investment advisor at all in the first place. And once you are, you will be an IAR of that business going forward.
Yep. Very good distinction there. So, the confusion, I think, comes in, do I even need an RIA? And most common, the question is, but I don't actually manage investments, so I don't need it to be an RIA, right? And the answer is no. Unfortunately, you actually do need to be an RIA. And I understand why people are concerned about this. Getting an RIA registered, going through the compliance process, doing ongoing compliance, it is a pain. It is time consuming. It does cost money, but there's a reason for it. And the reason is there are a lot of people out there that have taken advantage of a lot of different folks. And so this is the government's way of ensuring that if we're giving investment advice, that we are registered and that we are falling under proper regulation to be able to do for our clients what we're supposed to be doing. So You need an RIA if you are going kind of two definitions, I would say. That the general definition is if you are giving any securities related advice. Now, think about the definition of securities, and it's not just securities management, right? It's securities advice. So, if you're telling your clients which stocks to invest in, which bonds to invest in, which mutual funds, you got to be registered because you're giving securities related advice. I have had compliance folks tell me if you go so far as to recommend that they hold their money in a money market account, or they should purchase a CD with their emergency savings because, they're going to ask you, what do I do with my emergency fund? And if you answer that question, suddenly you're giving securities related advice. So that is kind of, my understanding, that's the broad definition. Some states, right, we have 50 individual state regulators that all have their own opinions of these things and their own regulations. Some states, California is notorious for this, say that if you are even a CFP, by definition of being a certified financial planner, you are going to be giving advice on securities. You can't avoid it. So you have to register as an RIA in order to do any type of financial planning work in our state. So kind of the general definition is pretty specific. Some states take it even further to say, look, a CFP automatically, or if you say you're doing financial planning, automatically is going to force you to go register as an RIA.
That kind of core definition is what drives it, and it's investment advice. I mean, technically, the formal rule is 3 prongs. You have to be giving investment. You have to have a business giving investment advice for compensation. So you have to actually be in the business of doing this, giving like random one-off. That's why like random one-off water cooler advice does not trigger this. You have to give it for compensation. So that's why all sorts of free services and education don't trigger it. But any kind of investment advice matters. It's not solely about doing investment management. That happens to be one of the most common versions of ongoing investment advice, but it's not a sole requirement. The issue is investment advice. And as Alan, as you noted, there are several states that take the view that if you're a CFP and you're holding out as a financial advisor, you must ultimately be giving some kind of investment advice at some point. Otherwise, how can you be a CFP holding out as a financial advisor? So they presume upfront that you must be giving investment advice. And if it's a business and you're getting compensated, therefore you trigger registration status. So, the mere process of doing that, and actually for most states, simply soliciting for that investment in business as a business for compensation, they expect you to get registered.
Yeah, and the other thing that trips folks up is this de minimis requirement. And de minimis being the 5-client rule, that if you have more than 5 clients in a state, you have to register there. So what people hear, I think, whenever they hear that rule is that, well, if I don't have 5 clients in a state, in any one state, then I don't have to register. And that is incorrect. So we can break this down in a couple of things. One, if you're a state registered firm, you need to remember 2 states. Texas and Louisiana, because they are the exceptions to the 5-client rule. They are the 1-client rule. So if you have 1 client in Louisiana or Texas, you have to be registered in that state. If you're SEC registered, New Hampshire and Nebraska become an issue. But for most of our listeners, state registered, Texas, Louisiana, always remember those. But for every other state, you can have up to 5 clients in that state without being registered. However, you have to be registered in your home state. That does not mean you can just have up to 5 clients in your home state before you register. To work with any clients, you must be registered.
Technically, to even start soliciting clients.
Absolutely, yeah.
To solicit for business, you have to register.
Yeah, which is where folks that are starting a firm get tripped up, because during the registration process, they're out saying, hey, I do financial planning. You can come work with me. And then they kind of delay until they actually get registered. That is actually incorrect as well. That is illegal. So compliance folks have told me you can say, I am starting a financial planning firm, but I am not yet in business. So you can kind of say, like, I'm planning to start a firm. I can reach out to you when it is up and running. Probably a gray area. But yeah, so you have to get registered. The de minimis rule says that if I am an advisor in Montana and I get a random client in California, because I work virtually with my client, so I can work with them anywhere. I get my client in California. I do not have to go register in the state of California immediately. I can have up to 5 clients in the state of California before registering with the state of California and letting them know that I'm there and operating in their state with 5 or more clients, but I still have my home registration as Montana. So basically the way the state registration works is you have your home state, kind of your office location. And if you are virtually based and do not have an office location, you have to declare one. It'll be your home address or whatnot, but you have to have somewhere that's home base, that's your legal business address. And then you go, basically, it's just a filing with the state of California to say, hey, I'm operating here. Here's all my paperwork. And now you have oversight over me. And you have to do that in every state that you get up to 5 clients, again, with a caveat being Texas and Louisiana. So that's the 5 client de minimis rule that trips folks up, that they think they don't have to be registered at all, but you absolutely do. If you want to do any financial planning work, in my opinion, even so much as financial coaching, if you want to do any of that type of work, you've just got to get registered because the risk is just way too great. Compliance is not that hard. It's not that complicated. It's not that expensive that if you're going to be getting into this line of work, you just need to go through and do the right things the same way you would not try to act like a doctor without having gone through medical school and getting licensed as a doctor. You wouldn't try to act like a CPA without having your CPA. Just go through and get registered. That's my own opinion.
Again, kind of the key takeaway for that. So 2 pieces. Number one is to be an advisor and to solicit your first client anywhere. If you're going to be in the business of giving investment advice for compensation, you need to register as an investment advisor and you will become an IAR of that RIA. And you generally do it in your home state because presumably that's where you're going to go get your first client. After you have an RIA, the states expect every state that you're doing business in to let them know that you're doing business there and register and notify them. So after you've created your initial registration, then you start adding additional states. And that's where this question of how many clients do you have in the state starts to matter, because otherwise it could get kind of messy. If every state treated it this way, then I couldn't pick up the phone and talk to a person in any other state without needing to register, which would basically just force me to register in all 50 states at once. And that has a little bit of cost because states have some filing fees and you may have to pay someone to help you do the state registrations. So we generally don't add states until we need to, which is why those de minimis rules matter, either the 5 client rule or the 1 client rule for Texas and Louisiana. So you start by, as soon as you're going to be soliciting any clients and doing your business, you need to become an RIA in your home state. As you add additional clients in other states and reach those de minimis rules, you need to add those other states as well. Now, I suppose the other layer worth noting is this thing called SEC registration. So larger RIAs that do business in lots of states have the option of registering with the SEC. And when you register with the SEC, in essence, you end out in the process getting a blanket registration across the 50 states that you don't have to do each state one at a time and figure out as you're crossing the lines. Large firms generally just end out getting registered across all the states by going through SEC registration. And generally that gets triggered when either you've got clients in more than 15 states or you've got more than $100 million under management. If you're not reaching those thresholds, the SEC generally won't let you register with the SEC. You have to go one state at a time. As you cross over those thresholds, it becomes an option. I believe now at $110 million under management, you actually need to become SEC registered because the SEC wants to oversee you at that size.
And for anyone out there that's saying, this is stupid, why do these laws exist? I will remind you that lawyers cannot operate in any state except the one that they are registered in. So we at least have it better than them. They can't take people in other states. So I love telling lawyers that we can have clients in every state and they're baffled by it. So, okay. So moving on to our probably final question here. I love this question, so I can't wait to hear what your thoughts are on this. I'm betting we agree on it. My boss is encouraging me to get my CFP, which is wonderful. I'm working on the education now, and then we'll start studying for the exam. I asked the other day if I could plan to study for the exam during work hours, and he looked at me like I was crazy. Is it wrong to expect that if he wants me to get the CFP that I should have to study on my personal non-work time? Any thoughts?
Oh, yes. I have thoughts. Out of sheer coincidence or not, I actually sounded off on a version of this for my office hours Periscope a few weeks ago as well. But the quick short answer is, if I was your boss, I would have looked at you crazy as well. I actually probably would have been thinking worse things, frankly, but I probably would have been respectful and just looked at you crazy. So here's the dynamic, or kind of the important distinction that I'd make. And I'm going to say this both as someone who's gone through this and, gotten the proverbial alphabet soup after my name, and as a business owner, as a partner in an advisory firm as well. So there's a big difference in between the education you need to do your current job, sort of the on-the-job training to do your job, versus the education or training that you need to move up to the next level, to advance your career. So stuff that you need to do your current job, things that would generally be on-the-job training, you do on work hours, and I think are fine to do on work hours. So, if you're a paraplanner, that might be learning Money Guide Pro software or Orion or other tools that you use in your practice, or even things like Word and Excel training, stuff that's a core part of the business and the thing you currently do, I think is the kind of stuff that we would normally expect to be on the job training.
And that could be basically going to conferences as well, because that's generally going to be during work hours.
Yes.
I will caveat what we're about to say, because I think we're on the same page here. And that is that if your boss won't ever let you go to conferences and tells you to take vacation days to do it, they are wrong. That's bad. Go find a different job. This is a different piece of this conversation. This is talking about, as Mike, I'm sure you're about to get into, this is talking about additional certifications and bettering yourself. So that aside, that we are not talking about just conferences here.
Yeah, and you've kind of hit on the transition here. So when you're talking about stuff that moves you up, that takes your job and career to the next level, frankly, that's on you. If you don't want to put in the time to study for the classes and do what you've got to do to move up, that's fine. Stay in your current role forever. You'll get cost of living increases. Other people around you will get promoted above you and will move on and up, because there are other people, I guarantee you, who are willing to put in their own time to get ahead of you, because it's a competitive world out there. So if you just want to stay where you are and get your basic on-the-job training for your current role, that's fine. But when you talk about doing the CFP so you can move up above being a paraplanner or associate planner or whatever it's called in your firm, and you want to get higher from there, that's on you. That's on you to make a commitment. Now, I think it's awesome that the firm is willing to finance the deal, because, CFP classes are not cheap, particularly when we're still early in our careers and we're maybe not making big bucks in the first place. Like a couple $1,000s a year on going through all the CFP classes is pricey for people. So I think it's great that the firm is willing to support you financially with this, but that doesn't mean they're giving you a free ride on this and that you can ask them for everything. They're putting in the dollars, which basically means all they're asking of you is to put in the time and energy to get it done. You don't have to put in the time and energy and cost. You just have to put in the time and energy. They're coming to the table with the cost, but that's on you. That's if you want to move up, if you want to advance your career, if you want to make more money, if you want to have more responsibility, if you want to get a promotion, a job title, if you want to be a partner in your firm someday or make your own, you have to step up for the CFP. That's on you, and that's on your time.
Yeah, a couple of thoughts on this. One is, think about it from the perspective of the business owner. And I know this is kind of what, like, just trust us, because you haven't been there yet. And it is kind of like that. I know I didn't listen to anybody whenever they used to say things like this, but I'll try anyway. And that is, like, as business owners, just think about how this looks. I'm telling you as my employee, I want you to better yourself so that I can promote you, so you can move from paraplanner to associate advisor, so you can take on more responsibility. So you're going to get probably 50% more pay, because that's what associate advisors make over paraplanners. And I'm going to pay for your education to do that. I am giving you the path. And then you tell me, and by the way, I don't actually want to do my full job that I currently have, because I want to focus on this other thing to move up. It just doesn't make sense. It's not something that most business owners are prepared to be able to offer. And maybe there are a few out there, and if there are, awesome, love that you're doing that, but it's just not a realistic expectation to have. And so I would just, honestly, I would just put that one in the can. If your boss is offering to help you better yourself, to be able to get promoted, to be able to take on more responsibilities, to get higher pay, that is definitely something you're going to have to do in your off time. And the second thought is, if you go back and listen to episodes on this podcast with our most successful folks, anybody that you respect, you do not hear them complaining about working too many hours. You don't hear them sounding very lazy. What you hear is that they spent years and years grinding, doing the things that they had to do, going and getting additional designations and certifications and going back for their master's degrees while working, getting their business started on the side. You just getting, we had one, Jake Keebler, was talking about, working at H&R Block to go learn how to do tax returns on the weekends. That was the way he learned, was, picking up a weekend job with H&R Block. Those are the things that it takes to be successful as a business owner, as an entrepreneur, and to really, if you want to make partner, that's the path. And I'm not a big advocate for 80-hour weeks, obviously. I like to when people can enjoy their lives, but it is just for a short time. Even if a year or two seems like an infinite amount of time, it is only for a short amount of time to go get what you need to do done so that you can start to move up.
And I think that's an important point right there, that it's a limited period of time, and you're not coming in to do this indefinitely. If your firm was just requiring you to work that many extra hours with no end in sight, that's not good. That's not healthy. That's something that needs to change. But, to say you're going to take the time, and I realize it takes a while. I mean, a lot of people go through CFP classes in 12 to 18 months, give or take a little. I know some that do it a little faster and some that take a bit longer than that before they go and sit for the exam. I get it. It's a year or two of your life where you're going to have to, give back a little on some outside activities. You're going to have to, party less on Saturdays so that you can wake up and work on Sunday mornings for a while. It means you're going to go out a little bit less on some weekday evenings. It's a commitment, but that's the commitment of getting ahead. That ultimately is what sets you apart, what differentiates you. Your path forward at some point is being ready and willing and able to work harder than to reinvest in yourself than some other people who aren't. So if you want to be one of the people who doesn't make that investment and hang out in your current job and position, that's fine. Hopefully the firm will have a place for you for a long time to come. But, I'll admit from the business owner's end, I want to support our people to move up and get better. And I want to help come to the table with some investment for them to do it. But I expect them to make a contribution as well, because frankly, it's going to be good for us both, right? My business can grow when our people get better, and our people can make more money and have more successful income and careers when they're willing to reinvest themselves as well. So there's a mutual investment, mutual benefit thing going on here for a limited period of time to get through it. Now, you may decide at the end of that, you want to invest some more time to move up some more. So, some people spend a lot of time climbing that ladder and putting in that time. Some get to a point where that trade-off isn't appealing anymore, and to each their own about where that threshold is. But, kind of getting back to the original question, I really don't think it's reasonable to say, hey, I appreciate the opportunity to get promoted and move up, and that you're paying for all my classes in order to do that. But could you also make me work less so that I can get everything I need for my promotion without actually putting in anything more than what I'm already doing to do the current job? In fact, I'll do less of the current job so that you can promote me and pay me more. That's not very appealing for your boss.
I mean, ultimately, you were hired to do a job. That job has to get done. And if you aren't the one doing it, they got to hire somebody else to do it. And I will say that you, along with other team members, are the most expensive, resource that the firm has. Staff hours, man hours are just they're the most expensive. To ask for that is just, I would say, not reasonable. I understand why someone might think that they, give it a shot, because, they always say the worst thing they can say is no. I wouldn't even bother asking personally, but you can give it a shot.
And I think even that's a point, one of those things that you learn over time is, that whole saying, the worst thing they can say is no, is not quite always true. when you ask questions like that, you're going to change some perceptions that people have about you, about your willingness to work hard, your true interest and desire, your self-motivation to really move up. If I hear questions like that from employees, I'm starting to ask questions of, well, I thought this might be a person who someday is going to grow enough that I can promote them to a very senior level position. And, they were willing to put in the time for a couple of years to do the growth that's necessary. I'm willing to stick with them and, pay the money for the courses that I still don't have to pay as a business owner. We can leave you right where you are if you want. I'm making a financial investment because I believe that there's an opportunity that you can excel and move up. But if you're going to exhibit to me that you're not that serious and interested about really sacrificing anything to move up when I'm sacrificing the checks of paying for all your courses, it makes me not very excited to invest in you. That can be worse than just hearing no. It's one thing to get told no. It's another thing when your boss loses faith in you. And frankly, that's what you risk introducing. Now, again, this doesn't mean you should take whatever your boss gives you. And, if they're making you work 70 hours a week and saying this is just what you have to do and it's never ending, there's an unhealthy level of this as well. But I think, frankly, something like CFP classes, because it is sort of a limited scope by definition, you're going to go through the classes and you're going to go through the exam, then you're going to be done. It's going to be over. When I hear someone isn't willing to make even that level of commitment, what I hear is that's a person who's just not very committed to reinvesting into themselves for growth. And that's not a person I'm very excited to have in my business as a business owner.
And kind of the one final point is we're harping on, for the employers out there that are paying for the coursework, even if they're not paying for the coursework, that means they're definitely not, probably not as supportive of you getting the CFP as the advisor owners that we're talking about right now. I most certainly would not be asking them. This is something that ultimately you're just going to have to do in your own time. And I know it sucks and it's just part of it. It is part of the learning process that, when you have a job. Now, if you want to back off to part-time in order to focus on bettering your career, by all means, you can have that conversation that, you want to back off to 20 or 30 hours a week so that you can get the CFA or the CFP or whatever it is, your master's or MBA, whatever it is that you're working on. But to ask for full-time pay for part-time work, I just don't think is going to go very far.
No, it's not. Frankly, and just the other thing I'd note really fast, I'm sure there are some people out there that are listening to this actually from the other end saying, Alan and Michael, if I email you, can I find out what firm that is that's actually willing to pay for this person's CFP because my firm won't? It's actually worth recognizing. There's still a lot of firms out there that won't financially support this at all. I think that's unfortunate and a bad decision of the business owner. But failing that, there are a lot of firms out there that don't pay full freight. I know a bunch that do cost sharing. We'll pay 75%. You pay 25%. I know a lot that say, look, you got to have the financial skin in the game. So you pay the course. If you pass and get a good grade, we'll reimburse you. But you're not getting reimbursed until you come out of pocket up front, pay for it, go through it, and pass. So you've got a financial and time commitment just to recover your dollars later. So you may net out to the same position, but frankly, you've got more risk looming over you. So, a firm that's actually willing to say, we'll pay the full boat up front, which I think at least is what it sounded like from this person, that's actually a pretty sweet financial deal. And frankly, just makes the point all the more. You're already getting more from your employer than a lot of employers give on this. So I wouldn't be pushing back on that further.
So that kind of wraps up the questions that we're going to be covering today during our Unhinged mailbag episode. So again, if you have questions that you would like Michael or my opinion on, feel free to join the VIP community at xyplanningnetwork.com/VIP. I think we have over 550, probably approaching 600 listeners in there now. So you're welcome to get in there, ask questions so you can hear from not only us and our very opinionated opinions, in which we are always right, of course, but also get in.
As opposed to the less opinionated opinions.
Dear grammar people, do not join VIP community.
You were doing so well on the grammar. I gave you permission to tangent and to use it as a verb.
That's right.
We made it through almost the whole show, and then
maybe I should have said with very strong convictions as our opinions. We have very few things that we are passive on, we should say. But
sure.
Join the VIP group. You'll get access to other listeners. You can chat with them in addition to Michael and myself. So, Michael, thank you for taking the time to be on, and hopefully this was helpful for everybody.
Absolutely. Thank you.
We really do love doing these types of shows, so be sure to keep sending in your questions so we can work them into future mailbag episodes. And also be sure to join our VIP community at xyplanningnetwork.com/VIP to hang out with other XYPN radio listeners, ask questions for future mailbag episodes, and to finally find a community of like-minded financial advisors. Thanks so much for joining me today. We'll see you next time.
You're not alone, and you're not crazy. It's scary starting, building, and growing your own financial planning firm. And that's why we put together a free private community just for you, the Cutting Edge Financial Planner. Go to xyplanningnetwork.com/VIP or text XYPN Radio to 33344 and join a network of thousands ready to change the lives of Gen X and Gen Y clients.